As we step into or get closer to our new financial year or our next financial period of our life, it's essential to review our progress for the past year and set goals for the year ahead. Are our goals realistic? How do we fare last year? What do we aspire to achieve this year? It's crucial to evaluate whether it's the right time to expand, whether we should buy something new, sell, or consolidate our commercial property investments. Setting our goals for the next financial year. In preparation for the financial year, we should identify the key objectives. Is there a property purchase or sale on the horizon? Is there something underperforming, overperforming, and should we act accordingly? Are there leases that need to be updated or buildings that require refinancing? Consider the predictions and pressure, potential interest rate hikes. Delaying a new loan may lead to higher repayments. How long will it be until interest rates drop? No one really knows how long it will take, whether they'll continue to increase or they'll start decreasing. This threat happens all the time. It's a cycle and it'll go on forever. This period, like happens all the time, there is a focus and forecast for high interest rates and the possibility of some sort of property correction, or that could also represent opportunities as well. We'll talk about that later on. It's vital to assess our readiness. Let's take a bird's eye view of our commercial property investment portfolio. If interest rates continue to rise, it might be wise to explore refinancing options in our bank, with our bank or mortgage broker. Can we comfortably service the loan at the moment? Do we have sufficient positive cash flow to accommodate future rate increases? Should we consider a fixed rate or stick with our variable rate? These are the considerations. Leases. Are our leases all up to date and fully executed? Should we consider renewing some or contracts to secure stability in case the market softens? It's impossible to stay informed about the current market and ensure that the rents we charge align with a fair market value. What is the demand for properties like ours? Are we generating positive cash flow from our commercial property investments? Are our leases all congruent with each other? Do we have a plan, 1, 5, 10-year plan for our property, possibly future development? Are our leases aligned together? One bad lease decision could cost you dearly. I've had clients that virtually lost hundreds of thousands, if not millions, from bad planned lease portfolio. Get someone to help you go through them all. It's easy to say that we'll sort it out later on, but time moves quickly. Decisions need to be made. Opportunities don't come very often. So plan well. Design those leases properly. Tax deductions. Are we maximizing our tax deductions? Have a kind of proper tax depreciation schedule. Maybe it's worth employing a quantity surveyor to go through your assets. Are you getting the right return from your depreciation? I found my experience that most property owners and business owners for that matter underestimate the value of their assets. That's dollars lost. Bad tax planning. Talk to your accountant. And also, if you do have a depreciation schedule, is it up to date? Have you incorporated things you've purchased in the last 1, 2, 3 years since you last did your quantity survey? It is very surprising. Happens so often that most investors fail to claim their full deductions. It's advisable that you consult with a quantity surveyor who can provide a comprehensive list of all allowable deductions for your accountant to go through. I can't stress this enough. Your property and real estate investment. The property market and prices are constantly changing. It's worth considering refurbishing or repositioning your property to attract new market. In the past, as I explained in my book, Commercial Real Estate Investing for the Residential Investor, well, on Amazon, I'll leave a link below this. I've had examples. I've worked for clients by simply positioning the property at a certain time. It adds a lot to the bottom line, increase revenue and rents and property value. And it allows you to go through bad economic times. Because let's face it, yeah, things change all the time. Look at the situation with retail, with COVID, how it's declined, back again, come back again. And situation with industrial, that's improved. So if you move from retail to industrial 4 years ago, you'd be well ahead. If you've gone the other way, behind. The same thing with hotel tourism investments. They went through a terrible time for 2-3 years during COVID. They're back again. Maybe it would have been a good time to buy them. Opportunities come all the time. Watch the market closely. What's happening? What's changing in the economy? How are people's behavior changing? Look at what's happening around the place. Where there are increases in rent, where there are vacancies. Keep a watch. Look for growth opportunities in the marketplace. Is it becoming different economy? Is it an aging situation in the area you're investing in? Is the age going lower? Are there more families in there? Are there more couples? Are there more retirees? What sort of people? Is it a higher demographic value, higher wealth, or decreasing? Adjust accordingly. Equally important is recognizing any potential instability. Should you contemplate selling the property? As I mentioned the examples beforehand. Real estate prices fluctuate all the time, and there are always reasons to buy or sell. But don't forget, when things get very tough, the reason you want to sell is probably the reason why people don't want to buy your property. Keep things in mind. Stay up to date. Move ahead of the pack. Opportunities come all the time. Consider the opportunity cost, whether you can afford to wait for prices to rise again. So situations where, one situation I've heard of a property which is on the market for 10 years. The owner wouldn't budget the price. As 10 years, who knows what the opportunity cost? 10 years of their lives stuck with this property, which they weren't happy with, and the joy they would have had it by selling earlier, a possibly early retirement, or put their money somewhere else, opportunity cost or something else, and time opportunity of enjoyment those 10 years. Would it be better and more beneficial to redirect your funds to properties with better cash flow or other investments yielding higher returns? Conversely, if you find yourself in a favorable financial position, expanding your portfolio may be a viable option. Has there been a recent impending council change in your area? Could acquiring neighbouring properties enhance the value of your property and development site? Surprisingly, these happen quickly. Investors don't look at these things. The best investment, many times, most cases, can be buying your next door neighbour. I've seen changes all over the place. It's inevitable. Land is a very valuable asset. You don't know. You may not be allowed to build a larger development now, but as the pressure mounts on the governments to create more housing and facilities to cater for the growing population, new opportunities appear all the time. You might have a height ratio of 2-1 at the moment. I've seen changes from 2-1 to 10-1 and 20-1 over time, and corresponding land values. Work with someone, get a plan together, and see your portfolio grow and grow over the years.